All right, let's dive right in. Look, in 2026, figuring out where to park your cash has gotten, well, it's gotten really tricky. For the last couple of years, cash was absolutely king, right? You could earn a solid 5% basically risk-free. But that whole era is coming to an end. With interest rates shifting, leaving your money in a regular old bank account has gone from being a safe move to a guaranteed losing one.
And I mean a guaranteed loss. Think about it. Your big bank might be paying you, what, a teeny tiny fraction of a percent, maybe 0.01% APY if you're lucky. At the exact same time, inflation is humming along at around 3%. You don't need to be a math genius to see what's happening. Every single day, your hard-earned money is losing its buying power. That's not safety, my friends. That's just a slow-motion drain on your wealth.
So this brings us right to the heart of the 2026 cash dilemma. We've actually got two problems we need to solve. First, where can we keep our short-term cash, our emergency money, truly safe? And second, for our long-term wealth, where can we invest it to get real returns that actually beat inflation? Let's break down the strategy. First things first, let's talk about what we're going to call the safety bucket. This is your emergency fund. This is the cash you might need to grab in the next 6 to 12 months for, life. And the number one, the absolute golden rule for this money is that it has to be completely 100% protected from market risk. No ifs, ands, or buts. So where does it go? The best home for your safety bucket is a high-yield savings account, or an HYSA. But wait, not all of them are created equal. You got to follow 3 simple rules. Rule 1. Absolutely no monthly fees. Don't pay to save your own money. Rule 2, make sure it's FDIC insured. This protects you up to $250,000 if, the bank goes belly up. And Rule 3, and this one is super important for 2026, look for a consistent yield history. Don't get suckered in by some flashy teaser rate that's going to vanish in 3 months. We want stability here, not a gimmick. Okay, so here's what happens. As those nice, safe savings account rates start to drop, people get antsy. They naturally start looking for higher yields. And this, my friends, is what often leads them straight into what I call the REIT trap. Real estate investment trusts, or REITs. They can look like the perfect answer on the surface, but chasing those juicy-looking high dividends, it can be a massive mistake for your long-term growth. This quote just hits the nail on the head. It says it all. With a lot of today's REITs, you are taking on the risk of a stock for the kind of returns you'd expect from a much, much safer bond. In the world of investing, that is just a fundamentally bad trade. You have to be paid for the risk you take on. It's that simple. So what's really going on under the hood? The big issue is that the whole world of commercial real estate is, it's in a bit of a crisis. Thanks to remote work and the fact that we all shop online now, office buildings and shopping malls are really struggling. So when you buy a REIT, you're not just buying a dividend check. You're often buying a slice of a portfolio that is loaded with debt and full of half-empty properties. Now look, if you absolutely insist on looking at REITs, you gotta know how to spot the big red flags. Here are 3 major danger signs. First, a payout ratio over 100%. That just means the company is paying out more money in dividends than it's actually earning. I mean, how long can that last? Not long. Second, high floating rate debt. A ton of these REITs have to refinance their cheap debt at today's much higher interest rates, and that absolutely crushes their profits. And third is the yield trap, which is so important we're gonna look at it right now. This is probably the most important thing to remember. When you see a REIT with some insane dividend yield like 12%, 15%, your first reaction shouldn't be excitement. It should be suspicion. A sky-high yield like that is usually not a gift. It's just a mathematical side effect of a stock price that has completely cratered. It's the market screaming, this company is in trouble. Please don't try to catch a falling knife just because it has a shiny dividend attached to it. Okay, so we figured out the safety bucket goes in a good HISA. And we know that a lot of REITs are just way too risky for our serious growth money. So what is the better path forward? The answer is to completely shift our focus. We need to stop chasing income and start building long-term total return. It's a huge difference. Let's just put them side by side. With REITs, your main source of return is dividends. And guess what? Those are taxed at your ordinary income rate. That's the highest tax rate you pay. Ouch. Now look at index funds. They deliver total return, which is a combo of price growth and dividends. And that growth part is usually taxed at the much, much lower capital gains rate. It's just a way more tax-efficient way to build real wealth over time. And hey, you don't even have to take my word for it. The data speaks for itself. Look back over the last 15 years. A simple, boring S&P 500 index fund has absolutely crushed most of the major REIT indexes. And the reason is pretty simple when you think about it. The world's most innovative companies can grow their earnings way, way faster than a landlord can raise the rent on an office building. So let's bring this all home. When you cut through all the jargon and all the noise, the best strategy for your cash in 2026 is actually a really simple two-bucket approach. If you remember one thing from this whole explainer, let it be this. Here it is, plain and simple. Bucket number one, your safety bucket. This is where your emergency cash lives, safe and sound in a reputable, high-yield savings account. That's it. Bucket number two, your growth bucket. This is for your long-term wealth, and it goes into low-cost, diversified index funds. And notice what we're doing for that growth bucket. We are leaving REITs on the shelf. The potential reward is just not worth the risk and the historical underperformance. And that just leaves us with one final question. A question for you to really think about. I want you to take a hard look at your own strategy, your own investments, and ask yourself this. Is your portfolio actually built for sustainable long-term growth? Or are you just chasing a shiny dividend that might be more of a warning sign than a real reward?